Okay, so on to the Fibonacci principles. So since the last content, this method has been refined. I did drop it in the AstroFX member zone probably around a year and a half ago, but I would just like to reiterate on the importance of the levels that I am using and to clear any confusion. Let's bring this in a second. So, one second, bear with me. All right, so Fibonacci, useful tool. Time frames, mainly daily 4 hour, but we can stretch it into the hourly. I wouldn't really use it on any time frame lower than the hourly. However, it can be used for, number one, bias and direction. Bias and directional force, which I will pull up on the gold chart in a moment, which can be magnetized towards a target projection. But foremost, right, Fib, the only tool that we use here. As you can see, left toolbar, snap, Fib retracement. I'm going to go ahead and draw a Fib retracement on here at the start to solidify which levels we are exactly using. Now you need to go ahead and put your settings the same as mine. Trend line, we want to take that off. 0, check. Uncheck, uncheck, uncheck. 0.618, check. 0.786, check. 1, check. Type this in, minus 0.618, check. Up here, minus 0.27, check. The rest unchecked. Levels, prices, percents, check. Labels, right, middle. Background, off. Distraction. And that is it. So when we're drawing the Fib, we go from point 1 to point 2, A to B. With the Fib, you click one area, and then you spread it down and right for the bearish momentum, and up to the right-hand side for the bullish momentum. So now you have those levels. Let me explain as to what we're going to be looking for here. Now, the reason I've taken off the 50% and 38.2% is because this is a product of refinement to simplify methods and layer on confluences in order to build structural highs and lows in accordance to waves, market waves. So from a high down to the low, so it's always going to be 100 down to the 0 or vice versa, boom, up to the 0. If I show you this, as you can see, taking it from low to high. Now, what we want to do is focus on, let's say, the market wave. So we have point A at a peak or a lower swing high. The market wants to retrace. Around here you would have had the 38.2 and the 50%. We've taken that off. And we want to look for a rebound from, ideally, the 61.8 in itself. A rebound from, worst case scenario, 78.6. Or anywhere in between the level of 78 and 61. So anywhere in between. 3 variables, more or less, to consider. What we can also do, what I do recommend, is we can draw in a box region. Again, with this, I would probably change to a lighter spectrum. You don't have to do that. I'll show you on the chart in a moment. But we're looking for a tap at the 61, where we can often find a rally into that zone, a rally exceeding that zone to worst case scenario, last case scenario, 78.6, then rebound, or anywhere in between. We can look for potential liquidity spots to be taken. We can mix it up with psychological levels, and we can also just mix it up with standard key zones, support, resistance, supply, demand, etc., which we already have drawn on the chart. Now, with that being said, what we're then looking for, by taking the market bias from monthly, weekly, daily, primarily weekly and daily, we are now looking for a rebound from 61, 78, or anywhere in between to come back to take out the previous low at 0 and head to the 2 target points. Now there's two target points on the fib, there's minus 27 and minus 61.8. What we can do again to refine this further is the minus 61.8, we can take that off. The minus 21 gives us an area in which we can now map onto the chart, and again, similar to the short confluences that we can build up in this zone or around level 1, level 2, we can now start to build confluence surrounding what we see on the chart, given around the area of the minus 27, A, B, C, and then D. With that being said, minus 27 is the potential for a new low. So we have primary high or lower swing high, new low, and then what we can see is a rebound around here into the process of price lapping back below and coming into the region of a new swing low. So it's a handy tool to have for rebounds, targets, and so on. So that's how the fib should be laid out, guys. That's how the fib should be laid out. So what I'm going to do, I'm going to delete this for a moment. Let's get rid of this, and I'm going to show you a few examples on the chart. In the Astro Tracking section, section 3, I will be utilizing this in a live market and recapping on any previous trade setups from Monday, Tuesday, Wednesday, Thursday, and also plotting it on as a potential area in which the price could maybe be magnetized back into, to sit on our hands and wait for that perfect opportunity to then drop the trade into lower target areas. If we look at the USD CAD on the day, we don't need to go that far back in time. And as I continue to go through the videos and continue to map out live price action, I will try my best to bring these concepts to life so you can engage with that onto your own charts and maybe even do some back testing. Now, number one, what we can do, we can go from the high here. First and foremost, it's good to go into the chart, set the levels, look at the psychological levels. You can use, obviously, the ray tool. You can use the box tool. As we have done here, we took the ray from the peak, then we've used the box tool to solidify the peak of the wick down to the body and bring that across as a potential target zone if the market was to be magnetized back into the bullish scenario to go long. Over here, we can take, there's a swing point high, and then what we can see, we do have a wave bottom which is formed before this pullback, and then we drop into further downside territory. Now, looking at this, from where we are right now, the price is here, we need to look for the high into the low. So I would go from, we can snap it right on the peak of the wick where our line has already been joined, and we can also drag it down to the, I'm looking at this wave, A down to B, bringing it across to the right hand side and snapping it on and building the confluence. So we've got point A at the top, B down to 0%. As you can see, the market has rallied recently right into the 61.8. I did mention just a minute ago that we can find rebounds anywhere in between these sections, section here, to forcefully push the market back down. Now, on this daily time frame right now, this can give us the daily time frame using fib on the daily. I wouldn't necessarily go into the weekly too much with a fib, just to layer it on there. And often, you know, the market isn't going to give you opportunity to draw the fib on. So from the highs into the lows, what's happened is the market has created a one top, two top. But if we zoom in and look a little closer, as you can see, boom, 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 drop. We spike through, we spike two, we spike through, we spike two. Both bodies close perfectly right on the 61.8 handle, given the price 1.3436. Now, with that being said, this can be used as a longer term perspective and a bias to give us the minus 27, which is more or less leading down to the wick of this candle. Anywhere around 2,900 it comes in at, but this can give us an overall viewpoint as to where the market can potentially fall. Given this is a daily time frame, obviously it's not going to fall overnight and give us one big candle from here to that. It's going to take some time. And now that is not to say that the market can't come all the way down, retrace a little bit, because again, there's going to be waves upon waves upon waves and waves within waves in this market. Coming in, we can see that the minus 27% extension is quite a few pips away. From current market price, 3,380, let's just say 3,400 down to 2,900, that's 500 pips. So that can give us a scope and give us a target. So if we do now, looking at USD CAD, where my crosshair is, we rebounded back off 3.3. Nice psychological level. Psychological level has held. If you track all the way back here, we can see that the market responded to it relatively nicely. Support, 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 support. A few wicks through that region as well. You guys know that some of the wicks can provide us with spottings and sightings as to where liquidity is lying. But here seems like a very, very stubborn point. Moving averages right now, they did cross over in the last 2 days, and price can rally back into this region. It could give, like we have top 1, top 2, it could give us just another maybe tap at the Fibonacci, and this is where we have to now combine time frames. Combining the daily with the 4 hourly to see the bigger picture, the larger picture, and the finer details. That is how I would approach the Fibonacci on this daily time frame. But for now, what I'm also going to do, I'm going to delete that. Normally, you know, at home, if you are doing Fibonacci analysis and you are layering the confluences, you can do your annotations where it's okay from point C. So we have A, B, C, D. We're looking at the C to D leg, and that is the scope. You can take a screenshot of that. You can put it into your archive, whatever currency pair you are looking at. And then from there onwards, you can track the progress into the next few days, weeks, and maybe even a month, maybe even 2 months. So taking this off the chart, 1, 2. Let's go into the 4 hourly. 4 hourly, we can clearly see, I had this zone marked on. I should change the box color, but for now, I'm just going to leave it at that. Horizontal ray at the base, 1.3250, psychological key handle right there. Now what we can also see with USD CAD, after rebounding from 3.3, there was a 100 pip rally up to 3.4, right there. The 100 pip rally into 3.4, you can see the wick rejections telling us that orders are being fulfilled, preferably from my experience and watching USD CAD in the last week or so, orders were picked up at 3.3, taken out at 3.4. Now, with the daily time frame and the daily scope, having the larger Fibonacci, let's extend this across a little bit. What we had here was we took the wicks, boom, boom, and now we can maybe get forcefully attracted back into this region. This region here is the Fibonacci on the daily. Is the Fibonacci on the daily, the 61.8, as I've just showed you. Now, from here onward, there's 2 things we can maybe do. One of them is taking the fib from wave 1, significant high after 1.3450 zone, where we can clearly see a rejection, down to the lows of the wick. So this wave, A into B. We double bottomed on B once more. 3,300, forcefully pushed the price back up, but look at the confluence that we've just built. The confluence is 3,400 psychological level. We don't really have to put a line there, we can keep it in our heads, and then again, that comes with experience and continuously repeating the psychological level structure and the rules. I can clearly see 3-4, but also what's important here, guys, is that wick through, wick through, wick through. There's 2 confluences telling us that there is a potential for a downside reversal. Now, I placed on the wick point right there, and what I can also go ahead and do now is take the 2 body of the candles, drag it down, drag it across to match up 1, 2. And look what happens. The target projection on the Fibonacci minus 27 layers perfectly at the midpoint. I couldn't really get more perfect than that. So what I'm potentially looking at now, if the market today, the market just closed, it's 10 past 11. I've been recording all week, all day. What can now happen is the market starts to push back down. In this case, when the market rallies into the 61.8 or even the 78.6 and forms spike rejections, that is our time to get into the market with tight stops. Stops, in the case of the Fibonacci, you want to keep your stop losses either at the wick highs, if it does give us an opportunity, or if the market runs and reverses anywhere in between, or even at the 78.6, in between 78.6. We want to keep the stop loss around 10 to 15 pips just above the 78.6 handle. Now what we can expect from this is that the market, boom, gives us a nice rally from 3,380 or let's say even 3,400, target 3,256, 150 odd pips. Then we can track maybe a rebound, give us another leg, then we can go A, B, C, D, and we cross that bridge when we come to it. So we have two Fibonacci's, one on the daily, one on the 4-hour time frame, both indicating there is a potential for a short opportunity. What I will say is that any market activity in the next coming week that may push the dollar up against the Canadian dollar, what invalidates the Fibonacci is a closure above the 78.6 on a daily. So let's say we had one more green candle and then one more green candle closing above that, we take the fib off, we get rid of it. The Fibonacci is now useless. And then we track and trace, and then we go from there. So this looks like, look at the daily as well. We're getting mixed signals on USD CAD at the moment because it is in a consolidation zone. Even though the MAs have just crossed to the upside, we want to be relatively careful because of the overall bias on this market. So what we can maybe see, Monday market open, we spike back through, we come back down, we reverse. I would wait until Monday evening's closure to actually track USD CAD. Or we could just melt primarily off the level where it's at and head a lot lower. Also, we have to consider the region where, the region just below us, we have the wick high there down to the bodies and across. If the market comes back and closes below that level, we can say this is a clean outright rejection of the 4-hour fib, and now we've closed below the level and we're ready to maybe move on. Ultimately, overall, if I now combine the daily fib and put that back onto the chart from A down to B, spread that across, bang, what we can clearly see is the overall structure and the overall target potential. This can be target 1 because we know there's going to be a supportive handle at this zone. We can then go ahead and put our region on there too, from the wick up to the body, and the market can potentially roll into this level and then it can bounce. Overall, we're looking for this move, but again, it can take many days, even maybe a month or so. And that's how I would layer up on the Fibonacci on the daily and the 4-hour. So put it on the daily first, do your annotations, do some chart mapping, do your journaling, put it onto a Word document, write something nice about it, nice caption as to why you think USD CAD is going to go from here to here overall. You can track that progress in a few weeks or months, whatever it may be. But the immediate fib, which we need to consider and think about now, is this one right here. And then we can take positions from A down to B. When I say A down to B, that's just the track. This is the A, B, C, D wave. So retracing my words there, take the market from C to D, 150 pips. Let's have a look at the GBP AUD because daily has been relatively messy, extreme mess on the day. What we can do though, we can take maybe from the highs down into the lows. The low is the low of the market open. We gap lower and then we pulled up higher in the last week or so. So let's just firstly try the daily in the last wave. So down, from up and down into this region right here. So what we can also see there on the daily, guys, is that the market forcefully flew into the mid region. This is why we want to wait. I wanted to explain this to you in further detail and then obviously take off the 38.2 and the 50% because of confusion. A lot of people are getting confused with the 38 and the 50. And what we want to do is clear confusion, make our lives a lot more simpler, clean cut, and only take the pullbacks that have maximum potential. Now here on the day, boom, boom, 1 day in, 1 day out, back below the MAs. MAs are crossed over, and then we continue the overall downswings. Significant high, the wicks off being thrown all the way to the upside. Momentum can't hold in the bullish territory, and the market is now ready to potentially create a new wave leg in the next coming week, down to 1.8150. I took this trade, closed it 3 hours ago, and I'll show you that in a moment, and I'm still waiting for that target potential because I do have just over here, and I could even go ahead and put my horizontal range, the base right there, so 8169, just below that we have the fib. Ultimately we can maybe even reach territories this low. Again, I can go in there, rectangle tool, body base, down to the horizontal ray tool, and we could come into 1.8. So now the market has been boom, 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 choppy, 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 and I'm just waiting for collapse on GBP AUD. If going into the smaller time frame, that fib is still applicable on the 4-hour time frame, so I don't need to go in and draw other Fibonacci's. Right now, what we can do is maybe just spruce it up right to the wick. So we've got 1 wick and then 2 wick right there. What we can see, the market came in 4 hours. 4 hours later, closed back below. We also closed below this key point right there. Market in this scenario, there's 2 ways we can work it. I'm going to show you the different options. Depending on if we are at the computer screen and we have time to sit in the chart and we can monitor this, any forceful pushes to the 61 or anywhere in this region, we can start to add short positions in this case. We can only really do that if we have a solid bias and solid confidence as to where the market is going to go. So I've gone from point 1 to point 2, point 3 spiked above, and then here we've had another confluence at point 4. So this trend line is merely a guidance tool, guidance system. As long as we're trading below that, GBP AUD on the daily and the 4-hour is in fact in bearish territory. We're still waiting for the snap, but it's getting there. It's showing us a directional bias due to the swings and lower swing highs. So with that, I didn't see this before I placed the trade, and again, this is all in the tracking, the second set of videos on GBP AUD and the chart tracking on section 3. I took the trade based on, we came back below this area, retested it, liquidity was taken on this spike, and I entered after this green candle. Nice tight stop, 3 to 5 pips above, market swung, tested it again, and then boom, risk reward, 50 pips, risk, 285 pip reward. Now, with the fib on there, next week we could maybe pull back. I could maybe look for another entry opportunity, but for now, I'm looking at, that was my original target, right into that region, but the Fibonacci has just added another layer and another confluence onto where the market can actually go next. When the market hits minus 27, if it does, and even the same with USD CAD over there, you take out the position, you wait for the next move, you step back, and then you can see if maybe it's going to create another wave, and then we can go from A, B, C, D to A, B, C, D, and so on. Going over to gold, another interesting setup with a fib. What I've done here on gold is more or less I've spotted weekly weakness as we came into this region right here from past data. Forcefully, market pulls down, retraces, market pulls down. This candle closed below the 8 moving average right there. Okay, but what we can clearly see on the weekly, this is a daily fib by the way, but you can see on the week how we tapped into the 61.8 and then we rejected ever so sweetly. Coming into the daily time frame now, what we can also suggest is this wick region across here where the bodies are, taking the horizontal ray, bringing it all the way across. We can see that the market pushed into the zone. I've gone from high into the low. Let me just fix that right at the base of the low, right there. The market retraced its steps, boom, pushed in. Many people will get caught short there, get caught long there, sorry. I'll explain that concept in a moment. But it's came into the 61, it's came into the region, okay? And also we have 1320, which is more or less reacted to as well, psychological level on the gold chart. And we also have barrier at 1325 above. There's a few confluences here which are going on. Market pulls back down. The reason why all of this mad price action is occurring right now is because the liquidity spot where these dojis were, lots of indecision, wicks at the downside. All orders are being taken out from this bearish leg. Orders are being fulfilled to create the retracement. Here orders are now being filled from this leg. And now gold needs to find the next wave. Where's it going to end up? Is it going to rebound from this back to the upside? Because remember on the daily, it doesn't have to go, or it often just can't go all the way down from point C down to point D. Daily time frame may take a little bit more time. It can pop up perhaps and then give us that leg. Over here though, what I can also see is the minus 27 extension. If I look back at some of these wicks, if I take the body from the top wick and bring it all the way across there, The Fibonacci lines up very nicely. So we got the liquidity, boom, we break liquidity pool, we come back in and then we shoot off. Here we're having issues, same spot, same pool. And then we need to know if, number one, are we gonna reject that, or are we gonna break through? Once we break through this pool, like when we break through pools, and also in the case of, look at this wick. This candle has closed above where the wick is, so it tells us momentum has made its decision. This is raw price action. Here, what we need to now see is the market, boom, give us a nice red candle, close here or even past it, better still. That tells us that the momentum and liquidity is now being sucked up one way or the other. Hopefully it's going to come through in the bearish direction, and then momentum will easily just step through and then it will take out that zone. What it will do from there, who knows? Could come lower, but again, we want to take every bridge and every step as it comes. 4 hourly here, we don't need to add any more fib on because there isn't any upside. If there was upside, and what we need to do, we have to confirm the market's made a solid base, taken from highs into the lows. What we could maybe see is market pulls back into this zone and then boom, fulfills right down here, back into these targets. So we have A, B, C, and then D. A, B, C, and then D. That's just a thought, and I will consider and entertain that thought and process if the market does break up. Again, this setup is explained on the tracking in section 3. On gold, we more or less had the plummet into the liquidity spot. We made one high, lower swing, two high, lower swing. We broke out of one of the 4 hour little regions right there. And now what we can clearly see, this was the entry on the break, but we've also made lower swing by about 1 or 2 pips. Market is choppy, it's finding its direction. Market closed choppy, let's see what it does for the coming week ahead. This trade, in the scenario of it's not really doing anything and it's Friday evening, take out the trade. I took this trade out in around 42 pips loss. Next week I'll see what happens, but all I'm really waiting for now to confirm bearish directional bias, I need that candle to come through. Otherwise we can just pop back up. Shorts, why it will pop back up is because the move from here to here, the orders have been taken, and now what happens is the market can retrace. It's light on its feet. It can now retrace until something else significant happens, and then we'll cross that bridge as we come to it. My bet is if we put the Fibonacci on from A down to B, we just remove this one to aid any confusion. Whoops. Let's get this one out of the way for a second. Where the market could potentially come into this zone, we have spots all around here. Anywhere around here. So we could come through, spike up to the 61, fulfill orders from the base end of these spikes to the left. Price can be dragged back down, and then we can make that ultimate wave to the downside. Okay, so that's what I'm looking at on gold at the moment. The daily wave, the daily structure. That's what interests me at the moment. And yeah, from there onward, I mean, gold can start to just rebound and go sideways for a while. But I have that on just to fulfill some potentials for targets, given the liquidity, bringing that across, and bang, bang, bang. That's all I have for now on the fib. The other element I'm going to just express is, why do we use this level? Why are we using this region? A lot of the time the market and people are more or less trading last case scenario from the 61.8. They'll have the 38.2, they'll have the 50% and 61.8. Many people may take trades based off the 38.2 or the 50 and keep the stops just above 61.8. The market may run through both of those levels, trigger stop losses above, and then react. Stops can be anywhere above here. So this is like a manipulation area. And you'll often find when you do track sometimes, let's say for instance, the principle of me thinking forward from A to B, and expecting maybe, okay, I can maybe get a better short opportunity anywhere around here. The market will forcefully push into that zone, look as if it's going long, and this could be off the back end of some news announcement too. If you look at this structure, significant high, lower swing high, it could make sense for the market to come in and make a new lower swing high right here in order for it to drop. Where everybody's trading from the 38 and the 50, we want to sit on our hands, wait for them to get stopped out, wait for the market to be pushed into this area, 1, 2, or 3, and then we want to go in and take the trade. Here onward, you are going to get the best risk-reward trade setups as well. So if you look at the short, and let's say it came into the mid zone, gave us some spike opportunities, fulfilled whatever it needed to fulfill, and then boom, came into the lower end spectrum. That's a decent risk-reward opportunity right there. So 1 to 8. Oh, sorry, no, there's that fib. That's a daily. That's a 1 to 8. And then we can mix up the daily and the 4-hour time frames to build those target confluences. 57 pips, 417 pips. So it's something that I am going to be tracing. You are going to see this in section 3. And we'll see how we get on with it. And yeah, I'm going to be utilizing Fibonacci now on various time frames. We can use the hourly, but there isn't too many hourly setups that we can adhere to. Let me see if there's any examples on this retracement up run. So we have A, B, market comes all the way back into the zone. And this is something that you may often see on the lower time frame, especially the hourly. You'll see the market forcefully makes a move, very irrational move. It'll spike into the region. As you can see here, we spiked to the 78.6. We swiftly whipped back up above the 61.8. So as soon as the price is trading back above or below the 61.8, we can enter the market, given that we now know the rejection is there. Market dips its head back above in this case. It didn't quite reach the 27, but again, we need to build target confluences going forward. So I'm going to leave this video there. That's an intro on the Fibonacci. That's why we use these levels. Daily 4 hours, great. Intraday on the hourly time frame is going to take a little bit more precision and patience and experience and discipline and mental strength and a lot of psychological toughness. But that's how we use it. So I'm going to be tracking this throughout later videos, and I'll be touching back on it on the live market.
I just want to go